All right, this is being recorded, and one thing I say at the beginning of all of these is please go back and watch this as soon as you can, because it will help this theory and everything else sink in the second time through. First time through, it's really kind of difficult to get a hold of maybe all the nuances that we're going to be talking about, but second time through is going to make it stick into your long-term memory. This is going to be on Long Straddles. I haven't done a webinar on this. If any of you guys have been a member, I haven't done one on this, and I'll go through all the reasons why I haven't done it really on this later on, but this is going to be on Long Straddles. I got to go over a couple of things real quick. My name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with a psychology degree and started investing in some stocks at first, and then decided to change my major from psychology to finance. Moved to Chicago after graduating, and one thing I used to always say on the floor of the Board of Trade is that my psychology degree probably served me better than my financial degree, just because when you're trading and investing, it really is a lot of psychological barriers that you have to break down. I mean, you have to get past the emotion and everything else and start sticking to mechanics. So that's a really hard hurdle. But once you've done that and stop thinking about it as money and more about as probabilities and trades, you'll be much better off. I've traded through most markets throughout my career. I've traded everything from stocks, financial futures, commodities, currencies, and options on all of these products in all market conditions. So I mean, I've pretty much seen everything that's happened and traded right through it. That's when we used to say on the floor, when there's blood in the water, that's the time where you really have to be active and keep your calm, because that's where you're going to make the most money. This is a disclaimer, basically says any opinions, news, research, analysis, or other information provided by Pro Trader Strategies, associate companies, or employees is for general commentary. It does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why is, unlike Stephanie, I'm not a financial advisor. I don't know what's in your portfolio. Therefore, I can't give you advice as to what you should put in that portfolio. I also don't know your risk parameters. Some people have a low tolerance for risk, and I have a high tolerance for risk. So it wouldn't be fiduciary responsibility of me to give you advice on this stuff, because I would be giving you advice as to what I think is right, and that doesn't necessarily fit with your risk parameters and or your portfolio. So and some of the things I'm going to be talking about in this webinar in particular, I may have in my portfolio, and I'm not trying to get you guys just to buy that and do the pump and dump and all that stuff. I'm trying to teach you guys, make you more educated so that this makes a better market. Bottom line is, do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. All right, like I mentioned before this started, to some of you, I am on Twitter. You can follow me at Wolfman's blog, or you can follow Pro Trader Strategies at Pro Trader Strat. I throw out a lot of my earnings trades on Wolfman's blog and other snark and stuff that I see that pertain to the markets and real life, I suppose. Okay, so this is how to trade Long Straddle. So it may seem very easy, you know. I mean, Long Straddle is really just buying an at-the-money put and buying an at-the-money call. Well, there's going to be a lot of things that go into this that you need to follow hard fast, because this, for one, isn't a strategy I implement very often, and it's very rare that I do. It's kind of along the lines of my Long Straddle webinar, in a sense, that it's very rare occurrence that I will implement this strategy, just because it is a very low probability trade. And being that as a low probability trade, there's got to be a lot of things going on. I've got to have a really good feeling about something happening in this underlying in order to implement this strategy, because it's got to have a really big move after you implement it, and you have to see volatility expand and a lot of other things. Last thing you want to do is put this strategy on and have volatility contract on you. This is even more so important than the Long Straddle, because it will absolutely crush those premiums, and you can start seeing a big move happen, but you're fighting that decay. And we're going to try and create it as a delta neutral trade, and I'll go into that more when we get on the platform. The reason why we want it to be delta neutral, because this strategy is going to be implemented in a scenario where we're not really sure about the direction, and you need to make sure of that. You don't really know that it's going to go up or go down, or you don't really have a bias that way, because there's better strategies to implement in that type of scenario if you think that the market is going to go up and or down. This is going to be one where, hey, I think that there's going to be a big move. I think that their new product may be a bust or a big hit. You know, I don't really know yet, but if one of those two things happens, we're going to get a big move in this underlying, and that's going to be big. The ones that I'm talking about are something along the lines of like the healthcare stocks, the drug stocks, the generic drug makers, things like that. And unfortunately, you know, they released something a little bit early on me. I basically was building my whole game plan around the drug stocks for today's webinar, and there was something that was released that they're even going after the generic drug makers. So a lot of the volatility in those drug makers really spiked, which is exactly what we would have wanted to see had it happen on like Tuesday after this webinar. But they released it a little early, so they took a lot of my bullets for talking points later. But we can kind of implement that a little bit. But we want to kind of create this as a delta neutral strategy for the most part, and that'll be relatively easy. One of the things to look at is the Analyze tab. This is from TOS, Thinkorswim, and this is what it's going to look like. You know, the last thing we want to do is have this stock trade flat for the next several days. We're going to go out further in time, but we don't really want this stock to trade right here on a flat line, just kind of juking back and forth on the 90, you know, somewhere. We want this really to have a big move. And as you can see with something like WIN, you know, when you build this strategy out, we're paying $12.50, which essentially means we almost need a $12.50 move. If it starts moving down, that's going to lessen a little bit because our premiums are going to expand a little bit for us, so that'll make it a little bit better. But at the end of the day, when we first put this trade on, we need a relatively big move, and we need that move to happen relatively quickly because this is going to start decaying. So as you can see, that's a big move, and WIN's not unheard of to see that big of a move, and it could happen, but just keep in mind it is low probability. So essentials for success, I mentioned this earlier, is picking the right strike. What we're trying to do is create a situation where we are delta neutral, because in this scenario we feel that there's going to be a big move, but you know, we're unsure of that direction, so we want to make it delta neutral as closely as possible. That's not that difficult when you're picking the at the money strikes, but there'll be a little bit of nuances to it that we'll talk about, because it's going to be off by 1 or 2, and that's just where we're going to create our bias for it. Picking the right duration. Now this is important because we're buying a strategy. Do you think we're going to go short term or we're going to go long term on this one? Because it's a debit strategy. That's right, we're going to be trying to pick the longer duration out here. The reason why we're going to be trying to pick this longer duration is because this is theta decay. This is what happens to your premiums, and the closer you get to expiration, that theta decay happens even quicker. So you're Sisyphes trying to push that rock up the mountain with this strategy to hold off theta decay, and that's very difficult. It's a Sisyphean task. So we want to try and get out here where it's a little bit easier to digest, if you will, this theta decay, and it doesn't happen as quickly. So it gives us not only a little bit more time to be right, but it also doesn't get that decay in our premiums, which is going to be the thing that we have to really battle against. Picking the right environment for this, we want IV to be low. Now this week we've seen implied volatility expand. VIX is, I think, up near the 20s the last I checked, which is an expansion in volatility. That really fits nicely, especially around premium selling. So we're going to have to dig a little bit deeper for some of these that have lower implied volatility. And we don't really want this to go through an earnings event. There's a lot of earnings out there, and if you have this strategy on going into an earnings event, despite the fact that you think that there's going to be a huge move, that volatility crush that happens right after that event is going to hurt you. You could be directionally right and still not make money. So keep that in mind. It's almost better to cover it right before that event when implied volatility is the highest, and put on a different high probability trade, like selling a strangle or something like that outside of the expected market maker move. Picking the right underlying. This means that we're going to be picking something that a lot of people are trading, where the bid ask is pretty tight, because the more you get in and out of these strategies at any given time, if you have to give up a lot of edge, that's going to eat into your overall yield. So we're going to look for stocks that there's a lot of participation in, and that's relatively easy to find, believe it or not. But one of the rules of thumb I talk about with the picking the right underlying is, if the stock is under $100, we want that bid ask on the options change or options montage to be, the ones that are closer to that, the money, inside of 10 cents. Another thing I say is, like, if you're looking at the price lines or the Teslas, Tesla's not really a good example because Tesla has tight markets, but if it's like a $200 stock, you want it to be like inside of 20 cents. So just take like the first two biggest numbers there. It's like basically a 100% or something like that. But if it's $200, you're looking at 20-cent wide markets, kind of. Put the decimal in front, and that's basically how many pennies wide you want to have to be your limit on that. Does that make sense for everybody? Can you buy if expected IV to go from higher to even higher? Good question, Trevor. Yes, you could, but just be very careful of that. I talk about it as the probabilities. Anytime IV is high or above 50, it's going to want to revert back to the mean. So to where its normal IV range is. Right now, we have a high IV. It's not to say that IV isn't going to continue to expand going into, say, this election, but nobody really can tell at that point. So I always look at it as when there's high IV, that's when you sell it. When there's low IV, that's when you buy it, because the opportunity is it's not going to go much lower. When it's low, it's probably going to start picking up, and when it's higher, it's probably going to go down, just because it's like looking at a chart, it goes up and down. When it's down, it's probably going to go up, and when it's up, it's probably going to go down. But, that's also the contrarian in me. But that does happen. I mean, I thought I was selling Lilly calls in a high IV environment for Lilly, and a lot of this stuff was coming out. If you guys watch my daily market commentaries, the IV has gone through the roof in Lilly, basically because of some of these things that they've been talking about with the drug makers and stuff. And the IV has come up. I've gotten my directionality correct, but I haven't seen that theta decay because volatility is holding it off. So I sold some puts against it, create a nice big wide strangle, try and take advantage of some of that expanded volatility that's hurt me in a sense. So, and I talk about all that stuff in those daily market commentaries too. Know your exit strategy before you're entering the trade. Like I said, this is a low probability trade. So this is one, you guys, if you decide to put this on, to have a very, very short leash on it. I mean, you have it tight, like ready to pull that ripcord at any minute. you're base jumping with this one, and you don't want something to go wrong at the last minute. You want to be able to get out early. So one of the things I talked about in this is when to exit the trade. When we are 10 days in the trade and we've received 10% profit. So that means if we paid, for an easy example, we're almost never going to only be able to pay $1 for this trade, but let's just say we pay $1 for it, you're getting out at $1.10. Same thing, 15 days, you're getting out at $1.15. Have a short leash on this. The reason why is if you haven't received your profit within these few days, the probabilities are even less going forward. So if you're not starting to see that move happen really fast, get out of it. Same thing goes for exiting the trade on the downside. If you basically look at this strategy and you've lost 25 to 50% of the premium that you paid for it, that's usually when I'm looking to get out. I don't want to risk all of it and know that it's going to be a low probability trade. I'm going to move on to something else. So our max profit on this is unlimited. Anytime we're doing an undefined risk strategy where we're buying calls for one, which we will be doing, the probability or the potential maximum profit is unlimited. Now keep in mind that is slim and none, because it's not going to go to, you know, a stock that's trading $50 not going to go to 100,000 or more within 72 days. I mean, that's just not probably possible unless one of these drug makers finds a cure for cancer, and then that could, I guess, be possible. And to the downside, if it were to go down to zero, is our max profit to the downside, but that's not very possible. What is this? Long Straddle. That's what she said, Rick. You caught me on one. Anyway, max loss is the premium paid. Anytime we are paying a debit, that is your max loss. So that is why a lot of people like doing debit spreads. I don't, just because debit spreads are lower probability trades. So that is a nice comforting fact that you know what your limited loss is, and you have unlimited profit, and that's really the hook that gets a lot of people. I'm not a big fan of especially the straddle, and can probably tell you in the last year I've probably implemented a straddle on the long side maybe once, because it's just not one of my favorites. And I want to express that, we've done a lot of different strategies, and I've kind of held off on doing Long Straddle and Long Strangle just because they're not one of my favorites. But I think it's very important for you guys to learn about this strategy, to know it, because there are the occasions where you will want to implement this strategy, but keep a short leash on it. And I can't emphasize that enough. It's just not a great strategy to implement because of the lower probabilities. When you hit a home run with it, that's what you're looking for with this one, is a big home run trade. And if you know baseball terminology and stuff like that, the probabilities of getting a home run, some guys go, are home run hitters and will only hit 20 home runs in an entire 160 game season. So, that's not a very likely occurrence. It's about as likely as that, probably. And then our break even, we're going to have two of them because we're long a call and we're long a put. So our long call strike, or you add in what you paid, the premium, to that long call strike, and that's where your break even to the upside is, and you subtract it from the long put, that premium we paid to the downside. Trevor's asking, what are your favorite strategies? Debit spreads for sure. But my favorite strategy is probably the strangle, and that's the short strangle. That's the one I usually implement the most. I think that one has the highest probability. It also has a lot of ways to defend it. There's just so many great ways to defend the strangle that's why I use that one the most, or creating a strangle around it. but I also like short call spreads, short put spreads when I'm in directionality. When we're in a really low implied volatility market like we've been in the past, then I do also implement the debit spreads. I'm doing those smaller though, so if you watch the daily market commentaries and stuff like that, if I'm talking about a debit spread, I'm usually doing those in smaller quantities than when I'm selling options premium. All right. Could you use the straddle and strangle to adjust a call or put position? It depends on if you're like long or short. That I don't usually use this strategy to. It's very difficult to defend this one because anytime you're doing a naked long strategy, I don't like throwing good money at bad money, which is really what I feel is with this one is you're going for a home run. It's not working out. I'm usually just getting out of this one to limit my losses. And if it works out, then I know I beat the probabilities is the way I look at that. All right, so enough of the boring stuff, you guys. You ready to pull up the platform and take a look at that? So this is usually where I start talking to you guys about start throwing out your favorite stocks or stocks that you think might work with this strategy, and we will go through the steps of what I look at for this particular strategy. Oh, one thing that I mentioned with doing this with stocks above high IV above 50%, or sorry, IV below 50% for stocks. We want the ETFs like the SPY and DIA, stuff like that. ETFs, we want to be below 30% because it's a basket of those underlyings. They're not going to have that volatility expand as quickly. So we want it to be really low for those. That being said, SPY being at 64 because the VIX is 22, that wouldn't fit this one. This is something that I would be looking to. Trevor was asking, what are my favorite strategies? I just, before we went out, before the close of the day, for the most part, I just sold a SPY strangle. And what did I do in there? I did the November 198 216 strangle in there and sold it for $1.91. So that puts me up there and there. So always trying to take advantage of high IV. BMI until this week. I don't know what you're referring to. You want to look at BMI? BristolMyers. All right, so a lot of good ones coming up right now. See, oh, there's a strangle I threw in here too. So BMI, we can look at BristolMyers, and if you watch the daily market commentaries, I got something on in there too, sold some puts in there. That was after that news too, so and I'm a contrarian, so like I said, that might not fit your risk parameters in there, so keep that in mind as well. So with BMI, to do a straddle, it's probably got high implied volatility is my guess. So 49, it's just below 50. That could be one of those things like Trevor was talking about, JQ, where it's got high IV. We could expect IV to expand a little bit more because everybody's talking about these different drug companies and everybody in the healthcare having issues with their pricing and stuff like that. So we could see it expand even more. But as you can see, they just had earnings. It collapsed a little bit. We could try it. We could look at it because they do have pretty good markets. So it's a $50 stock. We're below 100, and it is 6 cents wide. So that's inside that 10 cents I'm talking about. That's what we want to see, especially for those ones that are just out of the money. When you start getting deeper in the money, of course, that rule doesn't necessarily apply. But just when you're looking at the stocks, any of these that are just outside the money, that's what I'm talking about, trying to make it inside at 10 cents or $200 stock, 20 cents. Yeah, it did look better last week. All of these, I mean, when I was doing this, I had Aetna, Express Scripts, Teva, Mylan, Gilead, Johnson & Johnson, Amgen, all of those were like on my short list, and I think that they might all be off the list now after seeing what's happened. So anyway, so this is what I'm talking about. We're trying to make this as close to delta neutral. So this one's not giving us anything 50-50 on the deltas. It's 47-41 over here and 59-30 or 43. So it's almost like a pick'em. So if your bias is to the upside, like we're delta, or we are pretty much neutral, but you just have a feeling that maybe with BristolMyers, maybe all of this stuff. Bob can't hear anything. I don't know if somebody at home base can reach out to Bob and have him log back in or something, but he's having no sound. Is anybody else having any sound problems? Would a strip work better here? You know, I don't, from the long side, I don't like doing strips or, you know, calendars really on the debit side, but that's mine. I would just try and, if you really liked them for a position, you know, I would, there's so many different things I would probably do with this, but we can talk about that at the end. I don't want to waste everybody's time on that. Okay, Stephanie can hear me, sounds good. All right, good. Just Bob's having the problem. All right, so this would have to be a bias situation where we think that it's going to either go slightly up or slightly down. We just want to have a little bit of bias. We may not necessarily know, but it's just better to, okay, well, I think it's going to go because I think this stuff, it's going to either tank or it's going to really rally. Well, just try and pick them. All right, I'm maybe a little bit more bullish than bearish. So in that regard, if you're a little bit more bullish than bearish, you would pick the ones that are the calls that are slightly in the money. So we would hit the buy on the one that's at the money 50. And the other thing I would probably lean towards is I like the whole numbers rather than the halves. I try to stay away from halves if I can, but that might be another reason for me just to go with this one. They have a tendency, especially if they get deeper in the money or out of the money, they just have more participation in them. So it's $5.10. So our break even to the upside is going to be $55.10. Our break even to the downside is going to be $44.90. So that's how you figure out your break even. You can also go back and may have the other trade in there from looking at stuff, but there's something in there. Oh, it's because I have that other thing in there. So there's your Analyze tab. So as you can see, $500, because $500.10 is what we lose to the downside. It looks a little off there, but that's probably right on $510. And our break even to the downside is going to be $4.90. Break even to the upside should be $55.10. All right, so that's how you figure that one out. So as you can tell, then we know where our break evens are. We can go and look at the chart and know that, you know, it's had some volatility in there. $55.10 doesn't seem unlikely. To me, it's, you know, been beaten up. It really looks like support. So, you know, to the downside, it doesn't seem likely it's going to go there. So I would definitely have my bias to the upside. If you are a chartist and things like that and thought, okay, this is acted as support, it's not going to go any lower than this and stuff like that, this probably isn't the strategy for you. So keep that in mind as well. All right, so Sophie's asking, how do we pick the strikes again? So what I was saying was you're going to go at the money, or one is always going to be slightly in the money, but the ones that are closest to at the money. I mean, because you're never really going to get pick this strategy when the underlying is trading right at 50, and that's not really a reason to pick this strategy because it's landed exactly on the round number. So one is always going to be slightly in the money. But what we're trying to do is make our deltas even in a sense, because when we're buying these deltas, we're bullish 50, and when we're buying these, it means we're negative these deltas. So if we can get negative 50 and negative and positive 50, that would be perfectly delta neutral. But in this, I was saying, so they're making us have a slight bias. It's only a bias of maybe 10 deltas, but 10 deltas is meaningful. It's 10 cents for every dollar move, so it is meaningful. So with me and BristolMyers being as low as it is, I would probably default to the 50 just because it gives me longer deltas in that regard. And the other reason is because I don't like really the half strikes, like the 2.5s and stuff like that. I like the whole numbers because I have a tendency to see those have higher participation values. So we could look at open interest, and that's not necessarily the case with this one. The 2.5s actually have the higher implied open interest on both of them. So that's not true in this case, but that's usually when they start getting deeper in the money, you'll still see people trading the whole strikes more so than the half strikes a lot of times. And that's definitely not the case with BristolMyers, but just a rule of thumb. And maybe my own little quirk, I don't know. Do you scan LS candidates based on upcoming events? Any straddle ideas on TLT ahead of interest rate move in December? That's a good question. I don't think that they're going to do anything in December, so I wouldn't do a straddle around it. And I think that they're probably, you can look at the Fed Fund futures. I haven't looked at them in a while, but I think they're basically pulling the pricing out of that. As a matter of fact, Lockhart was saying that he doesn't expect an interest rate move in December as well. One thing about, they may always talk that they're going to raise rates in December, but Fed governors don't like to raise rates going into a holiday season. Think about it. It's not going to really affect anybody in December, but it's a psychological thing. People start seeing interest rates go up. Those people are not likely going to spend as much if they start thinking that they're going to start seeing interest rates increase. Raising interest rates is done to crimp spending. So they did last December, you're right, if you look back in time, they don't usually do that. And not that I agree with what the Fed has done anyway in the last several years, but that was always a big thing that they don't do it. And I bet if they had to do it over again, they wouldn't have raised interest rates in December, because it is a psychological impact and can really hurt retail sales. Why would you hurt retail sales going into the biggest buying season ever? It's just, to me, it just is blasphemy, really. All right, so that one we could probably get something a little bit cheaper just with if there was lower implied volatility. Everybody's blowing me up on the how does the cost compare to the expected move? Well, it is right in line with that. As you can see, it is 40. This is where you can find your expected move for the next 77 days, in parentheses there, plus or minus 510 or 556, and we've got a 510. But it is going to be very close. You basically have to go outside of the expected move. These are going to be lockstep with what that is. As a matter of fact, that's what the straddle really tells you is expected move. I actually have done a webinar on that. It's in the trader hacks and how to figure out what expected move is for everything. So it's very close to what that is. This might actually be even a little higher than what my numbers would give. And Trevor's asking why drug stocks. I like drug stocks because they come out with crazy announcements all the time, whether it's going to be the result of this preliminary drug test. They may have found that it doesn't work, and then all of a sudden the expectation that that drug was going to cure lymphoma or something like that, that gives you a quick, fast move. That's why I like it with drug stocks. You just never know when they're going to come out with an announcement, where a lot of other companies really only talk about it during their earnings calls. You know, you get your earnings event and stuff like that. So that's why I like to put this around something where that sector has a tendency to make some crazy announcements just out of the blue, and that's what drug stocks have a tendency to do, and you'll get those big, huge gyrations for a day or something. Okay. Brad's, I haven't checked the Fed funds, but I would think that it is probably close to maybe only 25%, which is pretty normal for a Fed move. I mean, I could check out what Fed funds are trading right now and tell you exactly what it is, but I don't know what it is right now. As a matter of fact, a lot of people ask me how I got my name, and it was from doing probabilities on Fed fund futures, and now the CME actually does a probability thing. I used to do it on the top of my head. They probably did some kind of algorithm on it for it. It's 33%, it looks like, right around there. So pretty low. And I think it's coming out. Lackard even said. Lackard's one that is usually a hawk, and he's talking like it's not happening. So I'd have to lean towards that. All right. So so let's just try and see what the drug stocks are doing. See if we can get Express Scripts. I don't know that they would really be affected by this as much as the ones that actually make the drugs, but it's up in 51%. You know, and notice that I'm going out 77 days. I'm trying to, 42 days is like the wheelhouse for selling strategies, 42 to 35 days. That's what I usually talk about, but Express Scripts is a $60 stock, and it's inside of 10 cents. So they have pretty good markets in there usually. What else do we have? Drug companies we could look at. And they've gotten spiked a little bit. It's below, but this is usually what I do. I just kind of, you know, I put Aetna maybe on the short list, Gilead, Gilead's, usually they're inside of 10 cents. It's pretty close. Those ones at the money aren't necessarily, but Gilead 44, so we could look at Gilead as well. I always kind of just check out the charts just to see what they're doing. It's at a low, and it's been in a downward spiral, but we could also look at past performance, not say that that's necessarily indicative of future results, but if it's been spiraling out of control from 82 to 72, that would have, straddle would have come into the money, so that would have been a time to do that. 10 cent, and I don't think that, yeah, $10, so it would have been just outside of it. So we can look at this one. Let's look at the deltas, because we're depending on our bias, right, whether or not we're slightly biased to the upside or the downside. 62.51, I probably default to these 2.5s. As a matter of fact, it's right there. Those are the at the monies. So the 72.5s is what we're going to be looking at. That gets us really close to delta neutral. We're biased to the upside by 2 deltas, which is almost nothing. And $7 to the upside, so we almost have to get to $80 to the upside and $65 to the downside, $65.50. So that would be something I would look at. If we saw the other one, see its market maker move is outside of what our debit is. So you know, that could be another indication as to being decent. Plus, we just saw it move down $10 within a month. So that would have made this one work. And it's steadily moving, but they could pop. That would be a good one for me to, you know, have a lot of things going for it to implement that strategy. But if you're used to doing larger quantities, shave your size on this one, you know, because this one's you're looking for a big move, which is relatively rare to happen. And if you're only used to trading one lot, it may be one that you hold off on for a while to start implementing this one. Because at the end of the day, you know, it's going to be $700 plus your commissions to implement this one, and it's a low probability trade. But in that, if I could get 70, 80 cents out of this one, I'm probably looking to cover this. If I can get 70, 80 cents out of this in like 10 days, you know, 15 days, if I can get, you know, $1 out of it or so, that's when I'm going to be looking to cover that. So that's how I play that. And if this starts going down relatively quickly, like we start seeing volatility contract on it and it's just trending sideways, I'm going to pull the ripcord probably after a $2 loss on this. Does that make sense so far for everybody? Do you guys have any other ones you want me to look at? I guess somebody wanted TLT, right? So we can look at TLT. I have positions on in TLT. Full disclosure. So here's another thing. So here's my thinking with TLT. You know, it's priced in for one. Another thing is I always look at this market profile. This is where the most time and volume has been spent. And if you've been watching my daily market commentaries, I've been talking about it basically pinging back and forth in between here, well, even down here, basically within this area for the next, until that meeting comes out. So, you know, that is just my thoughts. If you thought that there was going to be an unexpected move and they were going to raise interest rates, it would probably be a situation where you would do that then. So 40%, it's a little high for these guys. I would say 40% is a little high for treasuries, so I'd probably hold off. But in that, you know, the thing to do is to look for the most delta neutral on this, and that's probably the 131s. But keep in mind, you're going to have to go to 136.50, 136.50, let's say. So, you know, your probabilities, this is another way to look at your probabilities, is the delta where your break evens are. So your probabilities of getting to 137 is only a 25% chance, okay, within the next 71 days. So that's pretty low. Probabilities of us coming up there and touching that are about 50%, but for it to end in the money is only 25%. So that's what I'm talking about when you're buying that. And to the downside, what did we say it was, $6 or something, 650 from 31. So we're talking about the somewhere between the 125s, 124. So you only got about a 20% chance in there. What do you use to determine if the stock will make a big move? Trevor, it's really all around my gut for the most part, and that's why I like using the healthcare ones, because I don't really all that often even look at the underlyings in depth. I just kind of usually look at their IVs and start throwing strategies around them. But I do like the healthcare stocks for the long straddles and the long strangles, just because they have the tendency to come out off a binary event and say something. And what I mean by off a binary event, that means like off of a earnings event or ex-dividends event or earnings call. Those things are usually pretty laid out there. But these guys will make announcements on their drug trials within different times, and they don't always announce it. They might just come out and say, hey, this drug trial did not work out, and boom, the stock makes a big move. That's why I usually use this for the underlying stocks. But I'm not always looking, I'm not looking for a big move. I'm looking for high implied volatility. I'm looking for after that big move's happened or implied volatility is expanded, I look for it to settle down after that. And that's when I start selling strategies, which if you're watching the daily market commentaries, you're going to start seeing me selling a lot of strategies, credit strategies, because all of these have been past, or a lot of these have been out of earnings, and their volatility is expanding as the VIX is expanding 22. I mean, maybe add short legs on both sides. You could sell something against it, but keep in mind it's not going to, with this strategy, you're almost better off just buying it because, for instance, you're going to be risking a lot more than you're able to make. Then you're limiting your, this one you need a big move. So if I were to sell something for like only 40 cents or $1 or something like that, keep in mind that it becomes almost a 50-50, or it's less than a 50-50 at that point, because you would have to almost have it come all the way out there to make it worth that. And if it does, then you just kind of cap some of your profitability on it. So on this one, I don't sell anything to help finance it. It's I'm going out there and swinging for a home run, really. And I know my probabilities are against me. It's really just to keep me engaged and things like that. So it's not something I use very often, and it is the rarest strategy, I would have to say, that I ever put into my portfolio. That makes sense? I don't really expect a big move due, Rich is asking, do I expect a big move due to the election? I don't think so. I think that there's other things out there that could create a bigger move. I mean, I don't think that it's going to move that much if Trump or Hillary gets elected. The only thing that would be market shaking, I think, would be that if Hillary got elected and got indicted or something like that, which I don't even know if that's in the cards, but you know, that would be the thing that I would think happened. But I don't think anything's really going to happen on the election necessarily. So use stocks in at stock extreme, low, high, or middle. I do, you know, for instance, with like BristolMyers, you know, was at an extreme. Something like this, if I saw high volatility, which it's getting there, you know, I might look to sell a strategy around this. Right now, I'm actually long duration and shorter duration. I've been rolling those short calls out over time to lower my basis on it. But that was on the synthetic, or actually it was on the Poor Man's Covered Call webinar, I think, that I did the TLT on. On this one, I would probably look to just kind of throw a strangler around it. It's right there in the middle, right there at the 50 fib. I probably could sell something up in here and sell some puts down here and kind of capture that. Stephanie, he probably will contest the election, Trump. Anyway, do you expect to, I think I answered that one. I thought I saw a different one on there. Rick comes out, I'm glad your Cubbies won. Now you only have to wait another 108 long years. I don't know. We could have a dynasty with these boys, Rick. Does anybody else have any other questions or any other stocks you guys want me to look at real quick? Because Gilead, Johnson & Johnson was another one that I kind of had looked at. So Johnson & Johnson was one that I was looking at, but it also popped up, and we can look at the chart and see. I mean, when I was doing this earlier on in the week, it was below 50, and volatility on all of these have just kind of, as well as everything, So here's one that I was looking at. So Facebook, you know, they just came out with their earnings. They did do good on their earnings, I believe, and but they dropped like a rock, right? Because they said that it's going to be difficult for them to get any more users. Well, I mean, come on. Haven't people known that forever? I mean, 1 in 7 people have Facebook. Of course, it's going to be hard to get 100% of the population on Facebook. Having 1 in 7 is difficult enough. You know, Twitter's got the uphill slog because millennials don't use it, but millennials are actually starting to go towards Facebook. So anyway, so Facebook could have another big move in the next 70 some days. They have low implied volatility because it just got out of their earnings move. So I was thinking, you know, this would be one that would be a pretty decent one for that. It's going to have to pick an up or a down. So you guys throw it out to me. What do we want, up or down? This is probably closer to delta neutral, really. So up, all right. So $10, we need a $10 move on this. So that puts us at, or $11, let's call it. So we've got to go to 131, which is near the highs. So it's got to get back up in this range, or 109 or 108-ish, or come back down to the point of control. And that's another thing. If you guys watch that one on building out the platform, what happens is this gets overextended when it's well above the profile for a long period of time. And once it gets back down in here and settles back down inside of these value area high and lows, which act as support and resistance, but once it gets back down here, it really, believe it or not, wants to go back down here because that's where the most time and volume has been spent. Because what happens is people start getting out of their longs, and it just has a tendency to go towards this magnet. So that would be my theory on that one if I were to do Facebook on this, that it's going to have a move, and now that it's back in here, it's going to want to migrate down towards there. We could also look at we're paying $11 and the expected move is $12. And that's all based on volatility too, so keep that in mind. IWM, how to trade. IWM, I'd probably put in the same thing. You know, that's me, Stephanie. So I would say a strangle around it, just because we've gotten the expansion and volatility, that I would try and throw a strangle around it. Kind of like what I did in SPY. BBY, Best Buy. All right, somebody threw out this one. So we have 62%, and they also have an earnings coming up. When's Best Buy's earnings? It's coming up really soon, the 17th. So, you know, that would be one of those where, like Trevor was talking, expected IV to continue to expand into the earnings event. You could see it expand a little bit more. I don't know if it's worth the risk necessarily. But this is why I was saying, if you're going to do this going into an earnings event, because you expect volatility, this is a great example of volatility expanding, and then what happens the day after? Boom. So you could get a big move and still be wrong, you guys. That's why it's just not working for that, all right? So that's why you just never want to have this strategy on. Even if you get that big, huge move and it's outside the range, you could be looking at it like, oh my God, I'm directionally right, and I'm right there, and all of a sudden I just lost all my premium because of that volatility crush. Yeah, you should think that IV strategy. That's when you sell it. You know, that's why you see my earnings trades. You'll never see me buy a call or a put the day before an earnings event. Never. If you do, throw a rock through my front windshield. Make sure it hit me in the head, knock some sense into me. But that's why. Because I can be directionally wrong in this situation and still make money. That's why. VIX, I mean, you know, I have done it around, or I have traded VIX options. I rarely do, but as you can see, the VIX has a tendency to crush after, you know, it really expands, and it does it rather quickly. So this might be, again, something that I would sell like a strangle around, or maybe even some calls, because I wouldn't expect it to go a whole lot higher necessarily. But maybe do that right after, or right before the election or something like that, where you get the most expansion if it's going to continue to expand. All right. After earnings into the holidays would be good, yeah. IV is going up and get out before earnings. Yes, if you were going to implement this strategy, say a couple of weeks beforehand, get out of it before earnings, whether it's working or not. I mean, just get out. Take your money and run. Um, 10% out of the money paid by selling many fewer 10% out of the money puts. A big move up, big bucks. Yeah. If you're buying 10% out of the money, you get a big move, then yeah, you will. But I don't know if the probabilities are there, you guys. Rich, I mean. Any other questions, you guys? Anyway, so we got the trial membership offer for the subscription, $7, you guys. I mean, less than the price of basically a commission. And you get the daily market commentaries, which I go through everything from every single trade that I'm doing, that I'm putting on, when I'm buying them, when I'm selling them, how I'm defending them. My earnings trades really aren't there. They're on the on Twitter. I throw those out, but I talk about them in the daily market commentaries, whether they worked, how they're going against me, and how I'm going to be defending those to try and make some money on them still, stick with them, how to be mechanical. And you get access to over 50 videos. So we got expansion volatility right now. We've got a lot of great ones out there on the Iron Condor and stuff like that, the rules around that one. For some of you guys that may be trading in your IRA, that's a great one. My favorite's the Strangle, but the Iron Condor, I have rules around that one as well, and how to implement that. There's a little bit more rules going into that than just a straddle or the short straddle. So you can check that out. I mean, there's all kinds of videos in there, all the way to, you know, the history of options and where they got started and all that stuff. Really great stuff. And basically, if you guys take advantage of this and go through those videos, you guys will be professional traders. And if you guys want to learn to trade like a professional, or like a floor trader, really, that's what this is all about. That's kind of what that's geared towards. There's a lot of things that we were taught on the floor that's not really taught anywhere else in the real world. And this is some great stuff in there. People ask me, why am I doing it? It's because I want to make better markets, you guys. I don't want you guys just to jump off the cliff with me on the trades that I'm doing. I want you guys to learn how to do this so that we have so many more markets to trade. If you guys are all bidding and offering with me, we may have a different directionality opinion. We can still create tighter markets. That makes it better for everybody. And it's not true when people say, you know, investing and stuff like that is a losing proposition because there's got to be one winner and one loser. Well, that's not true, because I might be selling calls in something against my long stock, and you might be just buying the calls expecting it to go up. So that's what makes a market, and not everybody has to lose, especially when options are involved. There's just so many different ways to create spreads and hedge risk and stuff like that, that it's not that one person's always winning. So that's what makes it great about this. And this course will easily pay for itself at a $7 value. If you guys take anything even out of this video today to make money, like not implementing a long straddle all the time and just the very rare occasion, that's worth $7 in and of itself. I can guarantee you. That's the one thing I can guarantee you. somebody else. Have a great weekend, you guys. And so this link is in that chat box. So just click on that chat box there, and it's not going to be in the questions box. It'll be in that chat box that you can click on to get this. And you get access to the online live trading workshops, which is what this is, and all the old videos, like I said. Also, you get access to me, you guys. Like, if you have a trade that's going against you, it's not working out, you want to know what my rules are, and how I would defend that, what I would do in a situation. I can tell you what I would do, and it's kind of up to you guys to learn from that and be mechanical from there on out. But I can tell you what I would do and how I would defend it and what my rules are around that. So that's really valuable as well. All right. And you'll receive access to the trading courses free. So that's a huge value as well. All right. So you can, if you have any questions, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. And you guys, take advantage of reaching out to me and talking to me about your trades. I love to talk about it. That's about all I got for you guys today. Just want to thank you guys and say the later webinars, we're going to be drilling down on different options components, how I trade them, where I find them, when and where I find them appropriate. Here is that link that is in that chat box, so you can easily just click on that. And reach out to us also if you guys have a strategy you want me to cover and talk about my rules around it. I'm more than happy to go into that and talk about that, because I have strategies that I haven't covered yet that I've kind of held off on, kind of like this one, but I thought it would be appropriate. All right. That's all I got for you guys. Reach out and take advantage of that $7. You're not going to find it better anywhere else, that's for sure. Thank you, Stan. I appreciate it. Go Cubbies. JQ, have a great weekend. Everybody have a great weekend. Appreciate it. Yes, Trevor, this strategy fails miserably if there is no movement. Yeah, I'll do one coming up on a diagonal, because I think you were the one that was talking about those earlier. Yeah, we can do that for sure. Have a great weekend, everybody. If you can't take that, take it easy. Take care.